welcome into this Thursday's edition of May 7th edition of Freightonomics. I'm Zach Strickland here with Thomas Wasson, and here in a little bit we'll have Dr. Zac Rogers to discuss the April LMI, which expanded at the most rapid pace in its history. And I'm talking about the spread between transportation prices and capacity in the index. For those of you that have watched the show, you'll know the alligator mouth that I'm talking about that we'll dig into a little bit later. And in the meantime, Thomas Wasson, we've got a pretty big week coming up next week in the form of Roadcheck.
Oh, yes.
The mythical beast that I think everybody in the space has come to know and love and hate simultaneously, depending on your perspective. It is the week where we go through safety inspections, International Roadcheck Week. I think this year is
ELDs.
ELDs, which
is going to be a double whammy. I can go on a spiel. You want a little spiel on that?
Give us a spiel on ELDs.
All right, kids. So back in the day when Thomas worked at a large fleet, you had what's called the Safety and Compliance Department, and their job was to make sure for thousands of trucks that you filled out your hours of service logs. And, it's easier said than done depending upon your hardware, but when we look at Roadcheck Week, traditionally fleets stick out of it because they don't want a level 1 inspection. So the level 1 inspection is when it's like a cavity search at the TSA. You don't want to have it happen. They'll always find something. You can get points for a lamp. The little bitty running lights? Yeah, X's going to give it to you. They're going to come after you. So what I'm trying to say is that we have a 1-2 punch. In addition to 22 to 24% nationwide out of service rate, 1 out of 4 trucks can't pass an equipment inspection on a good day. Now we're going to look at your ELDs. And so the ELD component is huge. One of the things I want to talk about is we may see a more rapid increase because things like unassigned trips, false log violations. For casual listeners, they're thinking, well, Thomas, what does that matter? Well, if they find within 7 to 8 days looking through your books and they see that there's a little bit of thing like personal conveyance, like if you're off duty and you go 300 miles, you're going to be in trouble. You may be shut down for 7 days. So it's one thing to fix a maintenance issue on the truck and be put back in service. It is a big problem to be placed out of service for a log violation because sometimes you've got to wait a few days for it to fall off. And so we have a double kind of the perfect storm of situations. And Adam Wingfield, give him a shout out. He's in the studio today. He does an excellent job explaining it for fleets. But I think for listeners and even microeconomy, one of the things to think about is this is going to be a more pivotal Roadcheck week because we also have that capacity barometer. We got to see how much it goes. And traditionally, we'll see a bump and another level out ahead of 4th of July. How big's the bump? Can it stay in spite of higher costs and all this other craziness?
Yeah, traditionally we see a pretty decent little bump coming out of Roadcheck Week in times where we have plentiful capacity on the tender rejection rate. We also see spot rates obviously increase as well. And the ELD component of this, it's been under, I don't know how much scrutiny it's actually gotten. I know that we've targeted some ELD providers over the last year or so that have been found to not really be compliant with the regulatory practices. And again, it's kind of like nobody's paying attention. So the people that are operating in this space, they're not getting held accountable. So they're just going to keep doing it until they get caught or until they get told otherwise. And I'm curious to see how this year unfolds because traditionally speaking, when Roadcheck happens, we see rejection rates go up about 2 to 3%.
Yeah.
And in tighter markets, however, it doesn't really expand as rapidly as you would think. It's not a proportionate thing. Like I would have thought that in tighter markets, we see tender rejection rates actually go crazy. But that's not always true, especially during COVID. We saw it. It really didn't have a huge influence over the market at all because I think the market was just so tight. There really wasn't anywhere for it to go.
I got a great point on that. So Shelly Simpson, she did a post on LinkedIn a week or two ago talking about JB Hunt, how they went a week with no bad inspections. The large fleets are not worried about Roadcheck Week because they're doing their jobs correctly in the first place. That's why I told you the army of safety and compliance professionals that are constantly combing through the logs. I always look at Roadcheck Week as like the Catalina wine mixer of spot market because Roadcheck Week is where that capacity that is in the spot market, they are operating at the very edge. That's going to be their big thing. And so, like you said, we see elevated tender rejection rates, like 11, 12% in the dry van space. It's a great sign, but I don't think Roadcheck week is going to be that big in the tender rejection arena for sure.
Well, it pulls it in the way that spot rates go haywire.
Yeah.
And so it pulls people out of their low rate contract environment, especially if these rates were negotiated in November of last year.
Oh yeah.
That's the big risk. That's where tender rejection rates start to go higher, is because they get pulled into higher paying freight. So I want to get into it with Dr. Z here in a second. So let's go ahead and do the market in 2 and talk about some tendies.
Boom. Let's let the tendies hit the floor. I'll count you down from 5, 4, 3, 2, 1.
All right. Tender rejection rates, nationally speaking, we have just crossed the threshold of the seasonal low for the year. What has been the seasonal low for the year over the last several years in late April, early May, about this window between April 24th to May 10th. It's where we've had this low spot in the tender rejection rates. If that holds true, which again, we're in a totally different market now, that means that we just had the easiest it's going to be all year at around just under 12% rejection rate. And we got Roadcheck week next week, which is probably going to add a couple of basis points to it. And it's already increasing, mind you. So tender rejection rates starting to crawl back higher without any natural influence from seasonality, other than next week is Roadcheck week, which should not be materializing just yet. Let's go to the next chart. Break it down by mode. Flatbed continues to dominate the rejection rates here, up over 46% sometimes. All-time highs, hovering, not going anywhere. Surprisingly, the refrigerated market still in its settling pattern, and the dry van market holding up. Rejection rates still holding up here. Let's go into the rate chart next. Just for those of you that like to look at rates, moving very similarly here. Flatbed, spot rates on top, and the white continuing to be extremely volatile. AI data centers, of course, driving a ton of this volume and disrupting this market dramatically, on top of the fact that the national truckload market is tight in general. The flatbed market is having an outsized influence here. And then the refrigerated coming in second, as you would expect. And then dry van hovering flat. I mean, we are plateauing in the dry van market. Let's go to the STVI in the next chart. Demand, not huge. This is a very interesting nuance of this market flip. The STVI traditionally spikes. In 2017 and the 2020 markets, both were catalyzed by strong demand side influences. Yes, demand is good, but it's not spiking like it has in the past. It's just there. And we're about to hit the peak of demand. For those of you that don't know, fun fact, the peak, even though a lot of people in the industry call the peak season, the November, December, peak volume, as our Dr. Zac Rogers will also point out here in a minute, actually occurs in June.
Really?
That is the most voluminous month of the year for shipping.
And what's wild is even if you pull up the CLAV, which removes some of the tender ejection rates, we are below 2025 levels. We are actually below. It is the lowest level in 4 years worth of data when I'm pulling this up right now. So I think one of the great things to talk about, and we'll have to dovetail this in with Mr. Rogers, is that we've seen 3 major groups. We've got U.S. bank data, volumes flat, rates going up. We've got LMI data. We've got so many different data sets pointing to the fact that, it's a capacity and a supply-driven thing.
Primarily.
Very rare.
Yeah, primarily. Before we get into Dr. Z, I want to go ahead and say quick economic update. ADP, 109,000 increase in jobs. This used to be actually low. Now we consider it pretty good in terms of the labor market. Looks like it's holding on. Jobless claims down to 200K. We were at a historical low the week before. We're not moving in the job market is really what I'm reading here. I don't want to get too excited about this. The March numbers were up 178K for the overall non-farm payroll, so that's a pretty good sign. 1 month does not make a trend. However, again, I'm really hedging myself here in terms of optimism. AI, a large piece of GDP growth, which was up 2% supposedly for the early read. And 1.6% on consumption. So consumers are not really driving the economy right now, as we know, but they are holding on. They're holding in there. Labor market holding in there. Housing market remains a complete dud. Don't expect that to change this year with mortgage rates continuing to elevate. And of course, inflation, when you include fuel in it, it's a thing. Is it as big of a thing? There's some debate there. But Dr. Z, let's bring you on and get on with this because I mean, this LMI, I just started reading it and I was basically like, you know what? This is like This is like a movie. I want to watch the movie. And the movie is you telling me what this is going to be about, because the amount of strong statements in this report that it was leading off with, I was just like, you know what? I'm going to sit back and let Dr. Z cook here.
Let him cook.
I was running out of ways to say this is the biggest one ever. Like I mean, after about 10 times, you're like, I literally got the thesaurus out. I was like, what are some other words for stratospheric? I mean, it was really, it really took, but you know what? This reading deserved all of those adjectives, because this really was a huge movement in the overall index. Overall, we jumped up 4.2 points to 69.9 for the overall LMI. And just to remind everybody, 50 means no movement, over 50 means growth, under 50 means contraction. So we jumped up to 69.9. That's the highest that this has been in more than 4 years. And that's kind of we always take 70 as the sign that things are really increasing at a significant rate and expanding at a significant rate. So right now, the logistics, overall index is just knocking on the door of that 70. And it's really driven, by a few different things. You don't get to 70 without being driven by a lot of different things, but the cost metrics everywhere are high. A lot of what we're going to talk about today, I'm sure, is going to be transportation, which was at 95, which is the second highest that's ever been. But we also had inventory costs at 74.7 and warehousing price at 72.7. And so, you add all those up, it's about 240 points. That's a really big number. But like what you said a minute ago, inventories are only at 56. And so it's not like, in 21, because that was the last time we saw this many prices this high, when also inventories were just, we could not bring enough stuff in. Now, we see this big split here between the white line and the orange line. White line is inventory levels, orange line is inventory cost. And, they're 18 points apart, which is unusual in some ways, unless we're having a big disruption. You can see kind of in 21 when everything got really nuts, but we're not having these huge volumes of inventory come in. Now, one thing I will say is that it did seem like there's a little bit of shifting through the course of the month, because we average 56 here for our overall number. Well, for the first 16 days of April, because we always kind of cut the month in half. First 16 days, it was a 52 for inventory levels, which is basically we were barely moving at all, like really true like JIT in out cycling things over. By the end of the month, we got to 59. Which was interesting. And a lot of that was driven upstream, especially by manufacturers. I don't know if you saw some numbers came out in the middle of the month. I think S&P came out in the middle of the month showing that manufacturing orders were up for the first time in kind of a while. And just like similar to what you were kind of saying a minute ago with the labor market, that's good news that I think we should take with a grain of salt, because I don't know that it was up necessarily because, all right, here comes the manufacturing boom. I think part of what we're seeing is a pull forward of some components on the manufacturing side. And there's a couple reasons for that. One is just generally, I think more folks are now looking at freight consolidation, giving the increased price of fuel. The reason that the JIT stuff had really been working for the last 4 months was because the freight market was relatively stable. That obviously changed in March, and we're really seeing a change now in April. The other thing, and this is more, I think, forward-looking from the manufacturers, is where the places that are getting hit the hardest by the oil shocks are actually not here. They're abroad, especially Southeast Asia, parts of Africa. They're really getting hit hard. And some of those places are where you source pivotal components from. And so I think part of the pull forward we saw in the second half of the month upstream with our inventories is due to folks being worried that they may not be able to get the components that they need later on in the year if there are big energy shortages in some of these places where we source that stuff. So that's a small nuance I want to throw in with inventories. I have to imagine, though, that we want to talk about transportation, right? I mean, that's...
I don't know. I kind of like... I like where you were going there.
Yeah, I want to add something to that. So I was talking to a global OEM and they make trucks, but they have a large plant in South Africa. They have some in the Nordic countries. And so one of the things that you just touched on, I was like, I wonder how these guys are faring. Well, because for so long with the maritime and everything else and the energy was okay, you could allow yourself to save costs and ship other parts from abroad and have the finished goods assembled in the US. And so this touches on an interesting point that I hadn't considered, is like maybe that's why we're seeing some of this movement, because now the large multinationals who are finishing parts in the US are like, holy cow, I better stock up like a squirrel in case, Southeast Asia and other parts of the globe are impacted by Hormuz.
No, that's absolutely right. Because, I mean, if you think about it, right, we use 110 million barrels a day. We're getting about 90 million produced right now. So if we think about our supply and demand curves, well, America, we're right at the top of that curve, right? So we're just going to pay more. And we are paying quite a bit more. I saw diesel was up another 29 cents this week, which makes now for 5 of the biggest weekly jumps in the 30-year history of that index have now been in the last 6 weeks, or I guess 8 weeks. But yeah, so with those costs here, we just pay more. In other places, they just don't get it, right? Or they get much less of it. There's some rationing and gaming. And so I think one of the things that one of the stories of the second half of this year, we're already seeing it start now, but if Hormuz stays locked up, and who knows, because they announce that it's open every day and then announce that it's closed later that day. So I have no idea. But if it stays closed, and even if it opens tomorrow, it's going to be some time before we can circulate all that energy everywhere. And we're going to see, because of the long lead times of international supply chains, we haven't seen the cutoffs yet from places like South Africa, as you just mentioned, that'll impact components. And so here's what I honestly think when I see these inventories going up is, this isn't our first rodeo. I mean, we have just been hit over and over by these disruptions over the last 6 years, and manufacturers are not going to get caught the way they did in 21. In 20 and 21, we were like canceling component orders. I mean, the reason Toyota was the biggest auto seller in the U.S. in 2021, the only time it hasn't been a U.S. company, is because they still stocked up, even though we thought we were going into recession. So right. I would expect everyone has learned their lesson from last time, and that's why we're seeing this pull forward upstream.
So, I mean, that's fascinating, because there's the argument being made that, we're seeing a little bit of green shoot in the manufacturing data domestically. Mm-hmm. Like, I think there's something there, and it's hard to really parse that in a granular sense, because we don't really know what that means. I think your theory around like the fact that this is a pull forward activity has some credence, but this was happening in January in the ISM data. Is there any, do you think, I don't know that there was any thought, obviously, about the Iranian conflict was not top of mind at that point. I don't think anybody really thought that was going to be a thing. Is there something else going on under the surface other than just everyone's a little nervous about looking forward?
Yeah, certainly. I think that we do have manufacturing being reset in the U.S. Yeah. I mean, now the tariffs are here. I think last year there was sort of this, well, are they going to stay? Are they not? It seems for now that they are going to stay. I mean, sure, the IEEPAs are going away, but we still have the Section 301s, and it's going to be, I think, a little bit of a new ones are just going to come in, basically, to fill the old ones in a little bit. And so I think people thought, okay, this is real. Let's start pulling really things to the U.S. and or close to the U.S. at least, Mexico and places like that. And part of that is just it takes a long time to move global supply chains. Now, components are still going to be made other places. Like, we're not going to start making, nuts and bolts and socks and things in Ohio, probably. But we are going to pull some things closer. The other thing that I really think about why we were seeing that movement upstream is, okay, tariffs were settled. So now, if they're settled and not changing 53 times in a year, which they did change 53 times last year. If they're not 53 times in a year, then we at least, even if the cost is higher, we at least know what it's going to be. And so we can go forward. We can go forward from that point. The other thing I think is that coming into this year, there was a real expectation with Powell moving out and a new chairman coming in that the Fed was going to embark on some easing sometime this year. Now, obviously, that's changed a little bit because of the uncertainty around the war and what's going on. And so I think partly we saw it's kind of a combination of all those things, a pull forward tariffs hopefully being a little bit more level, and also I think earlier in the year, probably less now, especially if you read the minutes of the last meeting. But early in the year, I think they were thinking there was going to be some monetary easing.
That makes sense. Well, we gotta throw up the chart, the hyperbolic chart of the transportation price and capacity move. That is,
Open wide.
we've been talking about this alligator mouth now for over a year, because we were head faking, early 24, probably late 24, early 25. I always call it like the great head fake of the trucking market, because your index and our tender data was really sending a signal that this market was on the cusp of really turning and doing exactly what we're seeing today. Now, we're probably 13, 14 months late on that call. But I think we're seeing a stronger reaction because of that delay. Do you not agree?
It's a combination. So we really were like, we were like coiled. There was this potential energy waiting to be released last, like you said, about November to March.
Yeah.
So November 24 to March of 25, we were really like, we're just about to go. And then tariffs kind of dropped on top of us like a rock. And that there was so much uncertainty. It wasn't even the cost as much as it was the uncertainty. Well, now from the other side, so like I said, kind of tariffs have settled at least, and I think we were starting to see this increase, and then of course costs go up like crazy, because of the closure of the Strait of Hormuz, and so it's like we were coiled and ready to jump, and then right as we were jumping, a jetpack hit us, and we got way higher up, way faster probably than we were expecting, and so one of the things that about this report that made this month so memorable for me is the spread between capacity and price, which you just had up there. So, we always track those as sort of supply and demand, the interplay between these yellow and white lines. Every time they cross, it means something big happened. Yeah. And every time that the yellow line is really, really high, it means that we're in just a hot market. And what's interesting, guys, is that 28.4 for capacity is the second lowest reading we have ever had.
Wow.
In the history of this index. The 95 is the second highest we've ever had for price in the history of index. Not, by the way, just for these two metrics, for any metric ever, 95 second highest and 28.4 second lowest. The thing about that is when those two spikes happened, you can see the price. The only time price was higher was in the middle of 2018. The only time capacity was lower was at the end of 2020. So those happened 2 years apart from each other. Now they're happening at the exact same time. And what that means is it's a 66.7 point spread, right? Between these two, these two numbers. We've never seen, I guess 66.6, isn't it? That's ominous.
Easy.
It's 66.6.
Where's the Iron Maiden song?
Yeah. So anyway, it's a big, so this 66 point spread, that shows we have never had this level of movement in the freight index ever. Okay. It has never moved this fast going down capacity, this fast going up with price in the 10 years we've been doing this, which is why I think it feels like such an odd market. I was looking at, the market in two and all those charts you were showing earlier. It's just a weird market because for as much disruption as we've had, for as much crazy stuff we've had, it's never been this crazy before.
And I'm looking ahead as well. Let's pull that chart back up real fast. We're going to look at the length and the duration. So I love your data because the LMI data does a great job at predicting the freight cycles. You can see these areas in the circular ones. We're this early in the game, and it appears, at least as a trucking analyst, the supply side has been another huge factor. We talked about that pent-up demand, and right as we saw that pressure with the tariff and the pump fake, we had DOT and regulatory crackdowns not seen since the 1980s. And so, kind of looking ahead, what are some of your thoughts as we're looking ahead into maybe the future LMI data, and where do we kind of go from here, and what should we keep on our mind as we're moving into these kind of unprecedented times?
So you're absolutely right. Capacity has really kind of right-sized, I think, over the last year, and there's been the crackdowns, the English language stuff, all of that. But then beyond that, I think, we were talking earlier about how manufacturers really learned their lesson from 20 and 21. I think that fleets have too. We built up so fast in 20 and 21 in response to this kind of price growth. And what happened? Well, we had, we went all the way up. Those cycles, it's exactly right, Thomas. We went way, way up and then just came smashing down to earth in 22 and 23. And it was a bloodbath, partly because we had way more capacity than we knew what to do with. And so what I'm seeing so far, at least, is everyone's being very careful. No one wants to get way ahead of their skis, huge orders, because especially the similarities between this and what we saw in 2022, where there is really significant inflation. You add all our price metrics together, was 242.4, which is the highest that's been in 4 years. Anytime we're above 240, that usually means supply inflation is coming. I mean, you saw the PCE was up 3.5% last month. So we are trending in the upward direction. And I think partly what that means, you take all that together, is fleets right now are nervous about adding too much capacity. Because this could be sort of a burst, especially if PCE keeps going up and we see consumer spending come down. Because, consumers, the things that are really getting hit immediately right now are what? Grocery and gas. Well, you can't stop buying grocery and gas. We need those two things, but you could pull back on other stuff. And so I think, people are being really careful right now, because what's not clear is this a spike like we saw in 20, where we're going to have a really big market for 2 years? Or is this like what we saw in 2022, where an oil shock drove prices through the roof really quickly, and then we came crashing back down because consumer demand died off? And so what I would expect is we're not going to see, we'll see some come online, but I don't think we'll see a big rush of capacity coming online in response to these prices the way we did in the middle of 2020.
I've got a potential pump fake for you as well on that. One of the things looking at capacity entering is Class 8 orders. And so I was at an event, I talked with some Volvo executives, and I said, you guys had some gangbusters month. We've seen, out of season a lot of amount. I was like, what's going on? And they were like, look, the fleets are finally replacing their trucks because they have money. Like, they were like 4.5, 5.5 years old on the tractor. And so I think for a lot of analysts and folks looking ahead, what may make this persistently longer is that not only will the large fleets be very cautious, they're going to upgrade their older equipment, but the barriers for the new fleets to come in that crashed us out in 2022 with the modus and everything else, we see a lot more barriers to entry, IDEMIA, and all these verifications because of fraud. I think this is going to be an interesting dynamic because, like you said, we've got a lot more noise, and even the things we're used to looking for aren't going to be giving us reliable signals for a hot minute.
I think that's right. The other thing is, maybe some of them waited out the 4 years. Now they don't have to hit the same fuel regulation they thought they were going to have to. So now they can order the trucks they really wanted to order anyway. And maybe there's partly they're thinking, gosh, let's get these emitter trucks in now before someone comes in and changes the rules on us again.
Well, what are your, you've got the forward-looking component of the LMI. What's everybody predicting for the rest of the year?
Madness, mostly.
Okay. We've got a recency bias a little bit, but
yeah. So if we look, it's really interesting. A couple things. So transportation capacity 33, transportation price 94. So again, like a 60-point spread there, which is significant. The big thing that's different from our future predictions, say last month, the month before, we had been predicting inventories kind of mid 50s, which is sort of a healthy, normal replacement. This month it's 65.5, and upstream with our manufacturers, they're predicting increases at 68.
Oh wow!
And I think that again goes with this sort of, it's a pull forward. Where you have on one side tariffs saying don't bring inventories up too high. On the other side, you have high fuel costs saying consolidate freight loads and bring those lot sizes up a little bit. And what it looks like right now is, at the upstream side, they're going a little bit more towards let's consolidate. And with our smaller folks, with our retailers rather, they're going a little bit more towards JIT. Now they're still 59.60, so it's not as JIT as it had been, right, for the last couple months. But we're seeing sort of a split in the way that companies are choosing to handle what's really sort of twin disruptive costs and tariffs and the oil shocks. Upstream is saying, let's consolidate. Downstream is still trying to stay a little more lean.
Oh man, that's good stuff right there. Well, I can't wait for the next report to see how this unfolds. We got Roadcheck week next week that probably send your transportation price index a little higher. although it's hard to imagine that. But I know you've got finals. Thank you for coming on.
5 points of wiggle room, so there's not much space to go up.
I mean, for a 95 in April, it's traditionally not the most robust month of the year. So curious to see what happens there. But thank you for coming on. I know you got finals. I'm not going to keep you from your students in May.
Oh, yeah. Office hour starts in about 30 seconds. And, this is the last day of class. So a lot of folks found religion in the last 48 hours. Management 301 at Colorado
We'll see if
State.
the freight market finds its religion as well. Thank you so much, Dr. Z. We'll catch up again soon.
Exactly. And gets away from that 66.6. That's not the freight religion I'm looking for.